Hi everyone! Traders are still digesting monetary policy prospects. Last week, Jerome Powell hinted at further tightening as inflation remains unacceptably high. Other Fed policymakers voiced a similar opinion. San Francisco Fed President Mary Daly suggested that 2 more rate hikes this year were a very reasonable projection. Macrostats published last Friday revealed that U.S. business activity dropped to a 3-month low in June as services growth eased and the contraction in the manufacturing sector deepened. A rally on Wall Street stalled. All 3 benchmark indices ended the week in the red. They also started a new week with losses. A sell-off was triggered by profit-taking after a rapid rally in the tech sector since March. The main question is how long a downward correction will last and how deep it could be. Stock indices are likely to end June with gains, but there is a risk of a steeper correction next month. Watch our video review till the end and find out more interesting details. Let's start. Traders are now rather cautious because of the possible effects of aggressive tightening on the economy. They are also anticipating the results of banking stress testing. Apart from that, the PCE price index is on top. Investors hope to get more clues about the state of the economy from economic indicators. Meanwhile, the recession risks are mounting. On Tuesday, speculators will analyze lots of economic reports like home sales, durable goods orders, and the consumer confidence index. At the start of the new week, the Dow lost 0.4%, while the S&P fell by 0.45%. The NASDAQ decreased by 1.16%. The largest tech companies incurred the biggest losses as profit-taking continued. Tesla shares dropped by 6.1%, Nvidia stock sank by 3.7%, and Amazon by 1.6%. Microsoft's losses amounted to 1.9% and Meta Platforms to 3.6%. Shares of companies with small capitalization, on the contrary, climbed. Perhaps investors started to rebalance their portfolios at the end of the quarter. Goldman Sachs downgraded Tesla stock from a buy to neutral rating, citing the difficult pricing environment for electric vehicles. Apple shares posted decent gains. Apple is gearing up to launch its own credit card in India. The company is likely to cooperate with HDFC Bank to create a joint product. Meanwhile, credit cards provided by local banks prevail in India. After the visit of PMI Modi to the US, Google decided to invest $10 billion in India's digitalization fund. Amazon committed $11 billion investment in India, bringing its total investment to $26 billion by 2030. In addition, Boeing also plans to expand its presence in the Indian civil aviation market. Time will show whether companies will turn these plans into reality and how they will affect their shares. Currently, bearish sentiment prevails in the tech sector due to a crisis. However, a revival always comes after any crisis. Apple will present the iPhone 15 in the fall of the next 12 months. The company will also unveil a number of releases across all of its main product lines. Apart from that, new 24-inch iMacs are planned for release. Apple has also begun early work on a new iMac with over 30-inch display, which will be in the largest ever size for the all-in-one computer. The iPad Pro and iPad Air are also expected to receive updates, with the 2 iPad Pro models finally getting OLED screens. Although Nvidia shares have recently sunk, this company will hardly lose momentum. Its shares are in high demand among investors thanks to Nvidia's dominance in the oil scene. Microsoft also has ambitious goals. It aims to generate annual growth of at least 10%. That will get the company a revenue of $500 billion by fiscal 2030, more than double its current size. As for the indices, the Dow Jones suffered the biggest losses last week. They amounted to 1.7%. The downward correction is likely to continue this week. The index dropped due to the Fed's hawkish rhetoric. Judging by the comments made last week, the Fed may raise the benchmark rate 2 more times in 2023. Investors took these statements with a pinch of salt, as a week earlier the Fed skipped a rate increase. This pause can hardly be called a hawkish move, and there was no explanation of this step. This is why traders have doubts about further tightening. Some investors believe that a pause was a compromise between hawks and doves, who fear that the Fed could raise rates too high and trigger a recession. Hawks believe that without aggressive tightening, it will not be possible to curb inflation. According to Bloomberg, 9 out of 18 Fed policymakers expect 2 more increases this year. One of the officials assumes that the regulator could raise the rate above 6%. On July 26, the central bank may hike the key rate by another 25 basis points up to 5.5%. The NASDAQ index lost 1.5% last week and incurred an almost equal loss on Monday. It seems that something grander is about to happen. Companies that use borrowed funds to boost their development are at the center of attention when the stance on interest rates changes. That has affected the performance of the NASDAQ IT benchmark, which has added some 32% since January 2023. Currently, it is down by 4% from its high. The NASDAQ is located not far from the nearest support level. In June, there is a possibility of testing the ascending trend line slightly below the 13,000 mark, down by 3% from current levels. However, the market's current weakness could be attributed to a technical correction. Indeed, being extremely overbought, it needed to go down somewhat. Meanwhile, the uptrend is still intact. That means that a fall in quotes may soon be used for entering the market in the long term. Stocks that have consistently high volatility are now of greater interest. The ranking of the most turbulent stocks in the US market allows active traders to take risky choices and increase their profitability. Tesla shares tumbled by 6% on Monday. Earlier, experts pinpointed an interesting level for opening short positions, and the share price of the tech giant reached that point after a rally. The price is now 10% lower than the signal level, which is a normal fluctuation for such a volatile asset. In the coming weeks, the quotes may go down even deeper. The S&P was down by around 1% last week. Prior to that, the indicator had been approaching an all-time high of 4,800 recorded on January 4, 2022. Analysts claim that this is a correction, but their opinions differ about its depth. Uncertainty, as always, prevents them from giving an accurate assessment. A lot will depend on whether inflation is looming or not. Therefore, they will be closely watching US macro statistics this week. According to Goldman Sachs, the S&P will rise by 7% in the next 12 months. In case of a recession, the index is projected to lose as much as 22% from current levels. Goldman Sachs analysts point to a possible decline in the broad-based index to 3,400 in the worst-case scenario if the economy plays out. Otherwise, the index is forecast to rise to 4,700. However, economists still do not rule out the possibility of an economic downturn in that period. Experts say investors should hedge recession risks in the stock market because stock of companies with a high market capitalization are at their peak. What's more, the price-to-earnings ratio is now 19 times higher. Traditionally, when stocks trade at such high levels, a correction of 14% usually occurs next year. Bank of America analysts predict a rise in the S&P due to the fear of missed profits. Levels from 4,166 to 4,200 and 4,300 to 4,325, which previously acted as resistance, now serve as support. However, Bank of America is also warning some investors, pointing out risks in their bullish outlooks. Unlike the S&P index, other stock market indicators, including the NASDAQ, Russell 2000, Dow Jones, and NICE Composite, have failed to break resistance levels, which is a tactical risk. In early June, the S&P was believed to continue its growth and reach a new all-time high by the year end. The market still has significant upside potential, which will be driven by sustainable spending levels, declining inflation, and the end of the Fed's tightening cycle. While there are no such drivers, investors should pay attention to possible risks in the stock market and hedge their positions. Despite optimistic forecasts and upside potential, high stock values and accompanying volatility require a cautious investment approach. We continue to monitor the situation to keep you updated. Stay tuned and subscribe to our channel. See you in our next video.